All right, we're continuing to roll on with what is the best policy design for the infinite banking concepts. We have now done a bunch of episodes. We've talked about the Nelson-Nash model, 60-40. We've talked about the Beast, 75-25. We went over the special formula for the Slayer, 35-65. And now we're going to talk about what I think is one of the most controversial plan designs in the infinite banking world. So controversial that IBC practitioners almost forbid the use of this design. Now, we are IBC practitioners, so I'm not going to say we don't use this design, but we've learned about this design. We do use this. Matter of fact, just 2 weeks ago, one of my large clients had a particular need they needed solved, and this design solved it the most efficient way. But I want to really go into why the 90-10 is the most controversial. But what is 90-10? What does it mean? It means that 90% of all your premium deposits goes into the paid up additions rider. 10% goes into the base. So what does that mean? If it's all about the base, why are we putting it all in the paid up additions? That's right. It means you're going to have a really top-heavy plan. So what do I mean by top-heavy? Well, if you've got all that money going into the paid-up additions, that's a lot of money that you're going to have available immediately in the first 30 days. Now, I do want to preface the 90-10. It can be a very effective plan design if you're not doing a dump-in. If you plan on dumping money into your policy, if you plan on doing those dump-ins that you always hear us talking about, this plan design more than likely will not work. You're going to end up with a Beast or a Slayer because you'll mech the policy. But if you're just doing straight premium deposits on a regular monthly or annual basis, no dump-ins, this can work really well in the short run because you got 90% of all your money going to the paid up additions, which means effectively you have about 90% that you could use immediately in the first 30 days, give or take, depending on age and many other things. But then only 10% is in the base. So if 10 is in the base, 90 is in paid up additions, we need a whole bunch of term insurance. That's right. Almost all 90-10s require a lot of term insurance in a term rider, which hurts the efficiency. But for someone that's young, it can actually work well until the term insurance drops off. So if we put a 7-year term rider or a 10-year term rider, after that 7 or 10 years, the term's gone. We now are only going to have a very small amount of premium deposits that we can put in the policy. Now, I'm not saying that's bad for some of you. Some of you might be like, well, that's exactly what I want. I'm going to retire. I don't want to put as much money into savings during that time. Or this is for a particular need that's only going to be for the short run, like 5 to 10 years. Great. 90-10 could work for those really well, and we'll look at that. But if you're trying to do this for the long haul, if you're trying to become your own banker and you're trying to really just continuously build your banking system, put as much money as you can into your banking system, the 90-10 will eventually fail you because you will not be able to put a lot of money away once the term drops. If you were putting $10,000 into a policy, $9,000 effectively is going to the paid up additions. It's actually going to be less because we got term. So out of the $10,000, you're going to lose some to the term rider. But let's just keep it simple. $9,000 goes to the paid up additions and $1,000 goes to the base. So fast forward 10 years, term rider drops off. Now in the 11th year, how much can you put into your policy in premium deposits? And remember how efficient policies are in the 10th year. You can only put $1,000 in. That's right. Unless you kept the term rider on, which the term rider is going to start getting more and more expensive the older you get. So that 10% isn't going to give you the ability to save a lot of money in your banking system. So that's the problem with 90-10s. I think if you're going to use a 90-10, this is my personal opinion. In a second, I'm going to go through and dissect a 90-10 for you and show you the math. And for those of you looking for the short term and only looking at the first few years, you're going to like this one. But if you are a client that has a need in the immediate years for the maximum amount of cash value, this could work, okay? And if you're not doing a dump-in, this could work well. But please understand, this cannot be your only policy in your banking system. You're going to have to add additional policies and layer into the banking system because this plan is set up to fail right from day one. Your banking system, as it gets bigger and bigger and as you make more and more money and as you want to save more, after the term comes off, your savings plan just went out the window. You can't fund it. So please understand, if you do a 90-10, it cannot be a one and done. you're gonna need additional plan designs, maybe the Nelson, maybe it's the Beast or the Slayer. You're gonna have to layer in additional ones for longevity. So let's dive in. Before you dive in, it's Christmas soon, and a lot of people are going to be wanting some Christmas presents, this guy too. So I would love for you to click that subscribe button. That's right. And whoa, hey, coming in straight from Rudolph, that he, she little monster. Anyway, I need you to smash that bell. Yep, that bell that's up there, smash it, and that'll alert you and notify you every single time we put a new video out. Now, let's dive into the 90-10 and how this thing works. Now, this last design is a controversial one. If you talk to the Nelson Nash Institute, they don't even want their IBC practitioners talking about this design. But it is important for me to talk about it because there are other shops out there and other agents out there talking about this. And there are some people saying, oh, this is the best one, there's none better. I couldn't disagree more. This design is not the best design all around. The only thing this design is going to be best for is the high early cash value in the first couple of years. Because to design this policy, what we're going to do is we're going to shift everything. We're going to literally redline this engine. Now, let me ask you guys a question. In your vehicle that you have, if you just put the accelerator all the way to the floor and you get that tack redline, what eventually happens when you redline your car? You hear some funny noises in the engine, maybe see some smoke, and eventually your engine no longer runs. Because we're redlining this by putting 90% into the paid up additions and 10% to the base, so now out of the 10,000, we're putting 9,000 to the paid up additions and only 1,000 going into the base. We literally have now designed a rocket ship that kind of looks like this with these giant boosters. That's actually pretty funny. I've never drawn that before. So here's our booster rockets and here's our base. That's kind of what it looks like. So this thing gets off the ground super fast and this thing rockets into space. And when it's in space and it drops its booster rockets, well, hopefully for any of you men, when you look in the mirror, this is not the vision you get. This is not an efficient rocket. This is a failed rocket. But that's what we're designing. We're designing a rocket. We're designing a machine that will work really well in the early years, but will suffer in the later years. Let me show you. In the early years, we're gonna put the $9,000 into the paid up additions, which means we get $8,830 to use immediately. By far the best. You know, slightly better than the 75-25, much better than the 60-40, and this one's just in the middle. We'll come up to where the Slayer really makes a ton of sense. But in the 5th year, we put in $10,000 and we can take 11,000 out. So 10-5-20, 10-287, 11,000. You can see it's still better in the 5 years. The 10th year, we put 10,000 in, we take 14 out in comparison with 13, in comparison with 13-477. Not too much better. See how we're losing efficiency as we're going deeper and deeper into that? But see, here's where something miraculous happens, and this is something in transparency I want you to understand. These numbers here in the cash value look slightly better, but also we're putting an extra $378 in. We're not just putting 10,000 into this one. See, this one, in order for me to make this illustration work, I had to do $10,378. So right off the bat, I made this policy look better because I had to put more money into it. So I want you to understand that. But see, now, once we get down here to year 11, the most amount of money I can put into the policy is right there, $1,378. So in the 11th year, I can only put $1,378. And I'm actually gonna change up this number here because now my base is $1,378. I'd have to modify the numbers. I'm just trying to keep this simple. So now when I put $1,378 in the 11th year, I can take out $3,646. By the 15th year, I put $1,378 in. Remember what we said earlier? We want to put the most amount in the later years when the policy is the most efficient. I literally just cut my arms off here because now the most I can put in under the MEC rule is $1,378, which means I'm going to get less back. The returns are probably really good, but I get less back. Less money to use, less money to lend, less money to buy cars, less money to pay off debts. But I gained in the short run. So the 1090 or the 90-10 as it's called would be great for people that want really high early cash value, but You have to understand what you're giving up in the later years. And the other thing you must understand, to design this policy to work within the MEC rules, it required a much larger term rider. The term rider on this is more than any of the other ones at $150,000 in term rider. And we do a 10-year term rider, which is going to have almost double the cost. Okay, so our drag is now $294 for a period of 10 years, which is why you saw the policy losing efficiency in the later years. But some would argue and say, yeah, but I had more money to move and use earlier, and the money I'm making on that money working for me outweighs anything in the later years. True. Stay tuned, because in a moment I'm going to show you the best of both worlds, which is a proprietary design to us, and we call it the Rock. But let's just get through this. So now my death benefit on this policy is $192,417. But remember, a lot of that, 150 of that 192 is term. And in the 11th year, I'm going to drop that term rider because I'm going to drop the paid up addition. So the term in the 11th year is gone. We get rid of it. Okay? And you don't have to. You don't have to get rid of the term. And some people that design 90-10s will say, oh no, you just keep the term on. Let me remind you something. Every year that you get older, your term rider gets more expensive. Did you hear me? Every year after the 10th year, because it's a 10-year term rider, every year after the 10th year, your term gets more expensive. So as you get older, your cost goes up every year until the day you die. So that drag on your policy gets bigger every year, and there's nothing you can do about it. So why would you want to keep the term rider on the policy if we're trying to make it the most efficient policy we can? You wouldn't. But because we dropped the term, here's what happens. The death benefit in the 11th year, so in the 10th year, the death benefit was let's get through that, 10th year, $363,940. And it's more than the other ones in the 11th year because we've been throwing so much money into the PUA. But then once we drop the term rider, we drop down and we're only going to be $220,146. So we've given up death benefit, okay? We've given up efficiency, and now we have less money that we can put in at the absolute best time to put money in the policy. But there is one other underlying thing about a 1090 or a 90-10, depending on how you're calling it, that most won't tell you. Because we've got so much money redlining into the paid up additions, if dividends start going up, we're going to hit our MEC limit sooner, which means we're not going to be able to put as much money in for the period of time that we were hoping. And because we're in a rising interest rate cycle, the chance of dividends going up over the next few years is actually really high. So if dividends go up, we're going to have problems with this policy. We're going to have MEC problems. We're going to have to look at this policy and redesign it or put less money in it. So as you can see, that's the 90-10. It's really cool in some ways, not so good in others, but it does solve some of your problems. So I wanted to make sure we covered that. And also, while you're at it, I think you should check out another video, this one right here, how to design an IBC policy updated. And once you're done doing that, I got another favor. I asked earlier, but I'm gonna ask again. I need you to subscribe to this channel. So click the subscribe button, and also, there's Rudolph again, that he, she little bugger. I need you to smash that bell. And some of you might be looking at that and saying, what? Why are you picking on Rudolph? I have no idea how that happened. All of a sudden, Rudolph, which we don't know is Rudolph a male or a female, so all of a sudden someone said,
Rudolph is they. Rudolph is a she, he. I don't know.
Rudolph is something, but if any of you can tell me if Rudolph is a guy or a girl deer, put that in the comments so that I can stop having to go into this nonsense about whether Rudolph is a he, she, they, it, whenever. Please tell me, is Rudolph a guy or a girl deer? With that being said, thanks for joining. We'll see you next time. Oh, this just in. Rudolph has antlers, so Rudolph is indeed a boy deer. All right, well, I'm so happy. I forgot Rudolph had antlers. You guys know, did you know Rudolph had antlers? Because somehow I forgot about that. Whew. I'm so happy that we finally ended the he, she, they, it, whatever. Rudolph is a boy. Thank you. See you on the next one, folks.